Okay, guys, just one little developing story this morning. The Dow Jones has fallen more than 700 points. It's the seventh straight down day. The S&P 500 now it's down 10%. We're seeing this is unbelievable. Monday this morning, the S&P 500's worst week. Okay, last week was the worst week since March 2020. Remember what March 2020 was, and that continues this morning. I mean, wow. Big losses on the stock market this AM. Well, let's keep it going with the economy here. And let's talk about inflation. For the last few months, we've been giving you stories about the rising inflation rate. Last week, I was asking you about the things you're finding are more expensive. But just how long is inflation and high inflation going to stick around? What is exactly causing the cost of everything to skyrocket? Let's speak to one expert on this. Andrew Grantham is Executive Director and Senior Economist with CIBC. Andrew, welcome to the show.
Thank you for having me.
Andrew, listen, you look at those numbers, the inflation numbers, the high percentages in Canada. When you see those numbers come in every month, what do you think?
Well, I think at the moment it's thank goodness this isn't surging higher still, because even though these figures are big, 4.8% year over year, we are still a long way below the US, and also we are no longer seeing necessarily upside surprises in terms of inflation. What we were seeing 2 or 3 months ago, it wasn't just inflation picking up, but it was picking up much more than we had expected as economists. This 4.8%. Yes, it's high, but I think the good news in that, at least if there is some good news for people, is that it was no higher than expected. Those kind of months of kind of ever increasing, ever inflating, above expectations prices does seem to be coming to an end a little bit.
Now, do you have an idea on what the root cause? I've seen a lot of ideas bandied about, a lot of thoughts on why we're seeing this, but do you have an idea on the root cause of this high inflation?
Well, when you get inflation readings of this magnitude, it's never just because of one cause, really. What we are seeing is that a lot of the inflation still in Canada, particularly relative to the US, does seem to be driven by external factors. And by that, I mean, rising energy costs. I mean, they dipped a little bit in December, but they were still a long way above where they were a year before that. Rising food prices. We've had transportation issues there. We had poor harvest last year, and also rising imported prices for goods as well due to supply chain disruption. So there isn't necessarily just one root cause, but I think, and I'm not even sure whether this is good news for Canada or bad news, but a lot of this inflationary pressure that we are seeing does seem to be externally driven. Now, the good news for that is that maybe some of those factors will dissipate. They will kind of lessen in the future. The bad news, as we look forward to the Bank of Canada later this week, is that even if they do start to raise interest rates, some of the causes of inflation, and particularly the big causes, the externally driven inflation, there's not a lot they can do really about that with higher interest rates.
With Andrew Grantham, Executive Director and Senior Economist with CIBC, and we're talking about inflation. So, Andrew, it leads me to the question, what should governments do? What should we do about inflation? Just leave it be and the market will work itself out, or does there need to be some sort of intervention here?
So I think what the Bank of Canada will do is that they will this week either maybe start to edge interest rates higher, or they will at least, and this is our expectation, they will at least set the table for higher interest rates in the future. Because even though, what the inflation we're seeing in Canada, there's not a lot they can do about that. What they can do is make sure that inflation doesn't persist in the future, and make sure that this inflation doesn't become into something more domestically driven in the future. So I think, central bank at least has to kind of start edging interest rates up, or at least say that they are going to start edging interest rates up. A credibility issue there. That's what they can do to make sure that when these kind of global factors do lessen, we're not left still with high inflation, which is more domestically driven.
Andrew, every action has an equal and opposite reaction. So let's say we end up with higher interest rates. Does the economist brain of yours worry about the reactions to that?
It does, because this is what's changed really since the start of the pandemic is that we thought by this time everyone's vaccinated, that we will be able to reopen the economy, would have a surge in demand when it comes to services industries, and that we would be getting domestically driven inflation, and that would be okay for the central bank to raise interest rates then, because we could handle that, because the economy would be rebounding. Now, we're in the situation now where obviously the pandemic isn't fully behind us, and it seems like it's going to be a long way to get that full recovery in terms of the services sector still. Yet, because of these external pressures, the central bank is having to start, or at least having to threaten to start, raising interest rates to cool some other areas of the economy. So yes, we do worry about that, but this is one of the reasons why our forecasts, yes, we have the Bank of Canada raising interest rates. We think probably March, if they don't go this week, but we have them hiking interest rates fairly gradually, because they know that we're kind of a way away from a full economic recovery still, because the pandemic is still going on, and they are also very well aware that households will be more sensitive to higher interest rates in the future because of debt taken on before and during the pandemic.
Andrew, you mentioned near the top of this interview that there could be some good sides, positive sides to inflation. Give me the optimism here. give me the good that can come out of this period where inflation has been high.
Well, I think in terms of people's expectations for inflation going forwards, one of the things that a lot of economists were fretting about before the pandemic struck was that we were in a period of very low inflation, and it seemed like central banks, no matter what they did, they couldn't really generate inflation, and that got us stuck in a very, very low interest rate environment. Now, obviously, the pandemic has shown us with, obviously supply constraints, but also with the fiscal policy that we've seen, the government spending that we have seen, particularly in the US, that it is possible to generate inflation. So maybe as we get through this pandemic, we may not be stuck in this ultra low inflation, low interest rate environment that we seem to be stuck in previously. Now, that doesn't necessarily mean that inflation sticks where it is today, but the headache, I guess, for central bankers before the pandemic struck wasn't inflation of near 5%. It was, why can't we even reach inflation of 2%, which is our target?
And Andrew, do you look at inflation and say, well, depending on the root causes, there could be a good version of inflation? So for instance, I've heard people say that part of the reason we're seeing inflation everywhere is because of transportation costs, right? So if the price of oil and gas goes up, well, everything is going to be more expensive because just transporting the goods goes higher. So is there a difference? Like, if it's 5% inflation, does it matter where the inflation comes from?
Yeah, I mean, and this is what, going back to what central banks can and should be doing about it, is that if you have 5% inflation, which is driven mainly by supply factors, whether that be transportation issues, whether that be anything else on the supply chain, there's not a lot that central banks can do about that. Now, typically, when you have inflation in the past, it tends to be demand-driven. So you have a very, very strong economy, which then drives very high demand, then supply can't keep up, and that's what drives inflation. So that's generally considered a good kind of type of inflation, and that's the type of inflation that central banks know how to deal with, because they can raise interest rates, subdue demand a little bit, and cool inflation. Where we are today, we're not really in that environment. We're in the environment where inflation, for the most part at least, is driven by supply factors more so than those demand factors.
Andrew, I have time for one more question here. When it comes to interest rates and, the thought that they're going to be increased here, what's your magic formula for how high to raise them? I know a lot of people listening, they're homeowners, they've got their mortgages, and they hear interest rates going higher. They're not happy about that, right? So what's the magic on interest rates to get it right in response?
So this is it's a much more complex question than it seems, because we have this thing in economics called a neutral interest rate, which is basically the interest rate that people think you can get to without necessarily cooling the economy too much or heating the economy too much. And generally for Canada, most people put that in the 2 to 2.5% range. The trouble is, it's very difficult to know exactly what that rate is. And before the pandemic, we had interest rates of 1.75%, and the economy already, even at that interest rate, seemed to be cooling down a little bit. That interest rate still seemed to be a little bit high to some homeowners, and we were seeing a cooling in the market. So, that's what we look at in terms of where we think interest rates will settle. And that's one of the reasons why we don't think interest rates will go up quite as much as some other forecasters. We have, between now and the end of next year, we have 6 25 basis point interest rate hikes baked into our forecast. So we don't even have interest rates in our forecast hitting 2% by the end of next year. And I know, some other forecasters do, but we look at, the debt levels people hold, how sensitive people are to interest rates. Given the fact that demand hasn't fully recovered yet, we do think the Bank of Canada should be and will be fairly cautious during this interest rate hike cycle.
Andrew Grantham, Executive Director and Senior Economist at CIBC. Real pleasure. Thanks for coming on.
Perfect. Thank you.